In today's trading, modern financial markets process gigabytes of pricing data every millisecond. Parsing this noise requires immense mathematical precision. The Relative Strength Index, or RSI, is the most widely applied momentum oscillator in the world. Yet, rigorous quantitative backtesting reveals that its standard parameters generate zero statistical edge. This simulation tracks a default RSI strategy, using a 14-period lookback and 70-30 thresholds, plotted alongside a buy-and-hold baseline. The RSI model quickly plunges into a severe drawdown. Tested across a random basket of assets, the standard model consistently and severely underperforms. The failure comes from the application itself. Traders are applying a static, inherently lagging mathematical formula to dynamic, high-velocity market microstructures. To extract actual alpha, traders must abandon anecdotal chart reading and empirically optimize their mathematical parameters. Welles Wilder developed the RSI in 1978 for an environment that looked like this: a physical trading floor constrained by the limits of human calculation. An indicator calibrated for human reaction speeds cannot natively process the volatility of modern algorithmic flow. To modernize this tool, we must deconstruct the formula, isolate the variables causing delay, and eliminate the lag. We also need a dynamic trend baseline. By introducing an exponential moving average, or EMA, we can validate whether a sudden shift in momentum aligns with actual market direction. A statistically verified trading architecture requires both optimized momentum oscillators and structural price data filters working perfectly together. This is the equation for the Relative Strength Index. It measures the magnitude of recent gains against recent losses. The engine of this formula is the RS variable. It divides the average percentage gained on up days by the average percentage lost on down days. The mechanical flaw lies in the default 14-period lookback. In highly volatile assets, factoring in 14 full periods of price action severely dilutes the current momentum data. By the time the math averages out 2 weeks of historical data to trigger a signal, the actionable price movement has already occurred. The alpha has been extracted from the market. Retail traders attempt to bypass this lag by looking for RSI divergence, a visual mismatch between the direction of the price and the direction of the indicator line. Divergence is a hindsight bias. You can only confirm the mismatch after the price has already reversed, making it a lagging observation rather than a predictive edge. Furthermore, translating a subjective visual pattern like divergence into strict executable algorithmic code is exceptionally difficult because it lacks defined objective mathematical triggers. Reliable signal generation requires aggressive compression. We have to shrink the look-back window to prioritize recent data rather than hunting for visual anomalies on a chart. Even a compressed RSI needs context. We require a responsive trend filter to validate whether the momentum shifts identified by the RSI are actionable. This chart plots a simple moving average. Applying equal weight to every data point means the line lags far behind sudden price movements. Now we overlay an exponential moving average. It snaps to the current price, reacting sharply and immediately to the new volatile candle. This responsiveness is driven by a smoothing multiplier equation, 2 divided by the number of periods plus 1. This multiplier creates a mathematical decay function. As you move back in time, the influence of older price points shrinks exponentially. This graduated weighting system forces the indicator to hug current price action while retaining enough historical data to maintain stability. Using this specific, low-lag exponential filter is mandatory. It mathematically validates whether an RSI signal indicates a true reversal or just temporary market noise. Calibrating these tools requires adjusting the parameters for specific timeframes. We start with the microstructure of a 5-minute intraday market. In this environment, compressing the lookback to a 9-period RSI is optimal. It isolates exactly 45 minutes of relevant intraday momentum data. Shrinking the timeframe introduces a mathematical consequence. The significantly increased price volatility generates an excess of false positive signals. This chart displays a 9-period RSI on a 5-minute timeframe. To filter out noise, we push the thresholds to a strict 75 and 25. Overlaying a 9-period EMA creates a strict confluence model. We only enter when trend alignment matches the tightened RSI signals. Finally, we introduce structural price data into the model. We use unfilled fair value gaps. areas of rapid institutional buying or selling as precise execution zones. A profitable intraday algorithm relies on this exact confluence: tightened RSI thresholds, exponential trend alignment, and structural institutional footprints. The required mathematics shift entirely when we move from intraday volatility to the daily chart regime of major equities like the S&P 500 or the NASDAQ. Statistical backtesting shows that the optimal parameter for this specific asset class is an extremely short 2-period RSI. This graph illustrates a 2-period RSI. Drastically reducing the lookback means we must use hyper-sprint overbought and oversold thresholds of 85 and 15. The resulting data is highly erratic, but these rapid spikes identify the precise moments of statistical overextension required for a daily entry. We can refine this using a 60-50 momentum strategy. If the RSI crosses above the 50 center line and holds above 60, it detects an early trend shift on this highly compressed scale before it becomes obvious to other market participants. In daily equities, the default 14-period approach fails completely. Statistical edge is found exclusively in this hyper-compressed extreme mean reversion modeling. This comparative data table proves the cost of applying generic, sluggish parameters to non-trending environments. The left column tracks a 21-period Forex strategy. During flat market conditions, the delayed signals generated negative returns, losing 24 pips. The right column tracks our optimized 2-period strategy on the QQQ ETF. By compressing the lookback, the strategy achieved a 91% win rate. Notice the time invested metric. The optimized model was only exposed to the market 42% of the time. Parameter compression drastically reduces your overall exposure to market risk. With a maximum drawdown of only 33%, the data confirms that mathematically calibrated parameters mitigate systemic risk far better than a simple buy-and-hold baseline. Technical indicators possess no inherent predictive magic. They do not have foresight. They are strictly mathematical filters. They only function when their parameters are tailored to the specific microstructure of the asset being traded. True quantitative edge is never generated by discovering a secret indicator. It is built entirely through the rigorous empirical calibration of the mathematics underneath.